Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Carbon Markets and Investing, a guide to opportunities and impact. Governments set the caps for compliance markets, dictating how much carbon businesses in certain sectors are allowed to emit. These caps often lower over time, pushing companies to adopt cleaner practices. They also issue emissions allowances or permits and oversee their distribution, ensuring no one gets an unfair advantage. Additionally, penalties for exceeding emissions limits keep businesses motivated to meet their targets, since failing to comply can result in hefty fines or reputational damage. For example, in the European Union's emission trading system, authorities act as both referees and participants, regulating trades and monitoring emissions performance. These governmental roles ensure carbon markets don't become a free-for-all but stay aligned with international climate goals like the Paris Agreement. Corporations and businesses. Corporations are both contributors to the problem of carbon emissions and key players in developing solutions. Businesses actively participate in carbon markets for two main reasons: compliance and sustainability. Companies subject to government regulations must purchase carbon credits to cover their emissions if they exceed their allowances. This is mandatory in compliance markets like California's Cap and Trade program, which includes industries like oil, gas, and manufacturing. But beyond regulatory obligations, many businesses are voluntarily engaging in carbon markets. Why? Because customers and investors are demanding sustainability. Offsetting emissions isn't just about meeting legal quotas, it's about building trust and aligning with modern values. For instance, a global clothing brand might participate in a reforestation initiative in Southeast Asia to market itself as environmentally responsible, reducing its carbon footprint beyond what's required. Businesses also see carbon credits as a financial strategy. By adopting greener technologies, a company might emit less than its cap, allowing it to sell surplus credits for profit. It's like a reward system for doing the right thing, cutting pollution while creating a new revenue stream. NGOs and certification bodies. Non-governmental organizations, NGOs, and certification bodies play a watchdog role in carbon markets, ensuring transparency and validity. These organizations step in to verify that carbon credits represent real, measurable, and permanent emissions reductions. Without them, the market could fall prey to fraud or greenwashing, eroding trust in the system. Certification standards such as the Verified Carbon Standard, VCS, or Gold Standard are widely recognized benchmarks for ensuring the quality of carbon offset projects. These projects, whether it's building a solar farm or restoring a mangrove forest, must meet rigorous criteria before generating credits for the market. Certification bodies conduct audits, monitor progress, and ensure that promised environmental benefits actually occur. NGOs also help hold businesses accountable by tracking emissions data and advocating for greater transparency. Some focus on educating stakeholders, enabling smaller businesses or developing countries to access carbon markets. Others create tools like carbon calculators or platforms to connect buyers and sellers, making the system more accessible to all. Their involvement adds a crucial layer of credibility, helping participants trust that their investments in carbon credits genuinely contribute to fighting climate change. In a way, they're the referees ensuring everyone plays fair. Each of these groups, governments, corporations, and NGOs, brings its own expertise and responsibilities to carbon markets. Together, they create a system where environmental responsibility and economic activity can coexist, steering the world toward a lower carbon future. Carbon market investment opportunities. As the global focus on sustainability grows, investing in carbon markets offers both financial returns and a chance to contribute to climate solutions. From purchasing offsets to trading derivatives and funding green initiatives, individuals and businesses have many options to consider. Below, we break down some of the key opportunities and risks for investors. Investing in carbon offsets. Carbon offsets are a straightforward way to engage with carbon markets, but are they worth your investment? When you purchase offsets, you're funding projects that reduce or remove greenhouse gas emissions, think forest restoration or renewable energy. Companies often use these to hit net zero goals, while individuals might buy them to balance personal travel emissions. Profitability depends on the growing demand for sustainability. As more businesses commit to emission reductions, the market value of quality offsets can rise. However, risks like project underperformance or greenwashing, when offsets are marketed as more effective than they are, can affect their worth. Here's what to evaluate: credibility of the project. Who's verifying the emissions reductions? Look for standards like Verra or Gold Standard. Permanence. Will the offsets impact last? For instance, a forest project might lose value if wildfires or logging occur. Market demand. As regulations tighten, compliance-driven markets could boost offset demand, while voluntary markets may fluctuate based on trends. For businesses, offsets can enhance brand reputation and help avoid penalties in regulated markets. For individuals, it's a way to align personal values with action. Just keep in mind that not all offsets are created equal. Research is key. Carbon trading as a financial derivative. Carbon trading functions somewhat like stock or commodity trading but focuses on emissions allowances or credits. In essence, it's a derivative market tied to the idea of pricing pollution. Companies buy and sell these allowances, aiming to balance their emissions against legal limits. As an investor, you can trade these just like any other financial product. Why does this matter to you? Carbon allowance prices can fluctuate based on market dynamics like supply, demand, and government policies. For instance, if a country tightens its emissions cap, the price of allowances could soar, creating profit potential for savvy traders. However, this isn't a low-risk venture. Price volatility, geopolitical decisions, and regulatory changes can quickly alter market conditions. Market liquidity. In some regions, carbon trading is more active than in others. Local policies influence this heavily. Complexity. Understanding this market thoroughly is crucial. This isn't a set it and forget it investment. For seasoned investors, carbon trading offers high growth potential, particularly as global emissions targets become stricter. Think of it as betting on the world's push for sustainability, but with an active hand on the wheel. Green bonds and carbon funds. If trading and offsets seem too risky or complex, green bonds and carbon funds may provide safer entry points. Green bonds, issued by governments or corporations, raise capital for environmental projects, including carbon reductions. Carbon funds pool investments to support a range of initiatives, from renewable energy to efficient transportation. What makes these appealing? Unlike offsets or trading, these investment vehicles are designed for stability while still offering environmental impact. Here's what to look for. Green bonds. Check how funds are allocated. Are they directly tied to emission reduction programs? Bonds with strict reporting standards are generally more transparent. Carbon funds. These diversify your investment across multiple projects, spreading risk. Look for funds with established track records and strong oversight. Returns and risks. Green bonds typically offer lower but steady returns. Carbon funds may fluctuate more, depending on the success of the projects supported. For long-term investors, these options provide a way to back climate solutions while earning reliable returns. Plus, their alignment with environmental, social, and governance (ESG) goals makes them increasingly attractive to both institutions and retail investors. Whether you're seeking quick profits through trading or steady growth via bonds, carbon markets provide numerous ways to invest with purpose. The key is understanding the risks and aligning your strategy with your financial goals and your values. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.